Small samples test the trader. Large samples test the strategy. You can have 5 winning trades in a row and think you figured it out. Then take the same setup 5 more times and lose on every single one. Your strategy didn't change. The market didn't fundamentally shift. But suddenly you're questioning everything. That's what small samples do. They lie to you. They make randomness look like skill. They make skill look like randomness. And most traders never realize they're being lied to. You're making decisions based on data that means nothing. You're abandoning strategies that work because you didn't give them enough time. You're doubling down on strategies that don't work because you got lucky at the start. The line between noise and signal is 100 trades. Before that, you're gambling on incomplete information. After that, you're starting to see what's real. Flip a coin 10 times. You might get 7 heads. Does that mean the coin is rigged? Does that mean heads is more likely? Obviously not. 10 flips tells you nothing about the coin. Everyone understands this. But put the same logic into trading, and suddenly people forget how probability works. They take 10 trades with a new strategy. Win on 7. This system is incredible. 70% win rate. No, you flipped a coin 10 times. The strategy might be great. It might be garbage. 10 trades doesn't tell you which. But you're going to make decisions based on those 10 trades. You're going to risk more money because you think you found something special. Or you're going to abandon it after 10 losers, even though it might have a legitimate edge. Small samples create false confidence and false doubt at the exact same time. You trust things you shouldn't. You abandon things you should keep. And you're convinced you're making rational decisions because you tested it. Testing 10 trades isn't testing. It's guessing with extra steps. Think about what you're actually measuring when you take 10 trades. You're not measuring the strategy. You're measuring how the strategy performed under one specific set of market conditions over one tiny slice of time. That's not data. That's an anecdote. Your brain is wired to find patterns. It's a survival mechanism. See a pattern, remember it, use it to predict the future. The problem? Your brain finds patterns even when they don't exist. 5 wins in a row doesn't feel random. It feels like you've figured something out, like you cracked a code. 5 losses in a row doesn't feel random either. It feels like the system is broken, like you're missing something. But randomness creates streaks. That's what randomness does. Even with a perfect 50-50 coin flip, you'll get streaks. For heads in a row, 6 tails in a row, your brain sees those streaks and invents reasons for them. I was more focused during those wins. The market conditions were better. I took better entries. Maybe, or maybe you just hit the natural variance that exists in any probabilistic system. You can't tell the difference with a small sample. That's the entire problem. The trader who wins 7 out of 10 thinks they're skilled. The trader who loses 7 out of 10 thinks they're cursed. They're both wrong. They're both looking at noise and calling it data. Until you get to 100 trades, you're mostly measuring luck, not edge. Luck. Most traders quit or switch strategies somewhere between trade 15 and 25. They'll test something new. Get excited about it. Take a handful of trades. Hit a losing streak. Decide it doesn't work. Move on to the next thing. Then they repeat this cycle for years. They've taken thousands of trades in their career, but they've never taken more than 30 trades with the same strategy. So they've never actually tested anything. They think they're being adaptive. They think they're learning. They're actually just resetting the counter over and over, ensuring they never get past the noise phase. Every strategy has variance. Every edge has drawdown periods. If you switch strategies every time you hit variance, you'll never stick with anything long enough to see if it actually works. You need 100 trades minimum to start seeing through the noise. Not 100 trades across 5 different strategies. 100 trades executing the same approach, the same setups, the same rules. That's when the random streaks start averaging out. That's when luck stops dominating the results. That's when you can actually evaluate whether the strategy has edge or not. Before 100 trades, you're in the danger zone. The zone where a few good or bad trades will completely skew your perception of reality. At 100 trades, something shifts. The streaks don't disappear. You'll still have runs of 5, 6, 7 winners or losers, but they stop defining the overall result. With 10 trades, one streak is 50% of your data. With 100 trades, one streak is 10% of your data. The strategy's actual win rate starts revealing itself. Your actual average risk-to-reward starts showing up. The real drawdown characteristics become visible. You move from maybe to probably. You're still not at certainty. That takes even more trades, but you're past the point where randomness can completely mislead you. 100 trades is where you can start making real decisions. Should you keep trading this strategy? The data can finally tell you. Should you increase size? The drawdown data exists. Should you adjust your rules? You have enough information to know what actually needs adjusting. Before 100 trades, any adjustment you make is basically random. You're optimizing for noise. I lost 5 times in a row, so I'm going to tighten my stop. But what if those 5 losses were just variance? What if your stop was fine and you just hit a normal drawdown period? Now you've changed the strategy based on noise. In the next 100 trades, we'll be testing a different strategy than the first batch, which means you still don't have reliable data on either version. This is how traders stay stuck for years. Constant adjustments based on insufficient data. You take 20 trades, win 15, lose 5. That's 75% win rate. You feel confident. You should feel confident, right? The data says you're winning 75% of the time. Except the data doesn't say that. The data says you won 15 out of 20 trades in this specific sample. That's not the same thing. Your actual win rate might be 60%, or 55%, or 70%. 20 trades doesn't narrow it down. Do the math. With a true 60% win rate system, you'll hit 75% or higher in a 20-trade sample about 18% of the time, just from normal variance. That means almost 1 in 5 times you test a 60% system over 20 trades, it'll look like a 75% system. You think you found something special. You didn't. You found variance. The trader who sees this thinks they've got an elite system. They increase size. They get aggressive. Then the next 20 trades regress to the mean, and they give back everything plus more. Small samples don't just lie. They lie in ways that destroy your account. They create false confidence that leads to oversizing. They create false doubt that leads to abandoning working strategies. They create false precision where only uncertainty exists. 100 trades won't give you perfect certainty, but it'll get you close enough to make intelligent decisions. Bad traders see patterns in everything. They need meaning. They need explanations. They take 5 losses. The strategy doesn't work in choppy conditions. How do you know? You took 5 trades. Maybe the strategy does work in choppy conditions, and you just hit variance. Maybe it doesn't work, but not because of chop, because the setup itself is flawed. You can't know with 5 trades, but you'll invent a reason anyway because your brain needs one. Then you create a rule. Don't trade this in choppy conditions. Now you've got a modified strategy based on 5 data points. You're backtesting against noise. 3 months later, you've got 17 different rules, each one created in response to a small sample of losses. Your strategy looks like a patchwork of emotional reactions, and it still doesn't work because none of those rules were based on real data. Good traders resist this. They collect data before making conclusions. They lose 5 times. Interesting. I'll keep tracking it. They lose 10 times. Still tracking. They lose 15 times while winning 40. Okay, we're at 55 trades total. Let's see where this goes. At 100 trades, they look at the choppy days versus the trending days. They look at the actual distribution. They see if the pattern they suspected actually exists in the data. Sometimes it does. Often it doesn't. But they waited for real data before adjusting. So when they adjust, it's based on something real. You test a moving average crossover strategy. 10 trades. Went on 6. Not bad, but could be better. So you optimize. Maybe a different period works better. You test 20 periods instead of 10. 3 trades. Went on all 3. Found it. No. You found 3 trades. This is curve fitting in real time. You're optimizing for noise, then treating the results as if they're meaningful. Here's what actually happened. You got lucky on 3 trades with a different setting. That setting might be better. It might be worse. 3 trades tells you nothing. But now you're trading it live. You sized up because you're confident. The next 7 trades lose. You're confused. But it worked in testing. It didn't work in testing. You witnessed 3 random outcomes and called it testing. This happens constantly with small samples. Traders take a basic strategy, hit variance, then start tweaking everything trying to improve it. Each tweak is based on 5 to 10 trades. None of the tweaks are validated. They end up with a Frankenstein strategy that's optimized for one specific market condition that happened to occur during their tiny test period. The moment conditions shift, and they always shift, the strategy falls apart. The right approach: pick your settings. Trade them for 100 trades. Look at the data. Make one adjustment. Trade that for 100 more trades. Repeat. Slow. Methodical. Based on actual information instead of noise. Ever notice that profitable traders all sound the same when they talk about their process? I take the same setups. I risk the same amount. I follow the same rules. I track everything. I review monthly. It's boring. There's no excitement, no innovation, no constant improvement and optimization. They're boring because they learned the lesson about sample size. They found something that works. Not perfectly, just something with positive expectancy. And they executed it enough times to verify it actually works. Then they kept executing it. Same way, over and over. They're not optimizing every week. They're not adding new rules every time they hit a losing streak. They're not switching strategies every quarter. They're collecting a large sample on one approach. That's it. The traders who never make it are the opposite. Always exciting, always learning, always improving. New strategy every month. New indicators every week. They never get past 40 trades on anything, so they never know what actually works. They think they're being proactive. They're actually preventing themselves from ever getting useful data. Trading success requires boredom. It requires taking the same trade in the same way until you have enough data to actually evaluate it. Most traders can't do this. They're addicted to the feeling of discovery, the feeling of improvement. So they stay in the 20-trade cycle forever. Always testing, never knowing. Let's get specific about why 100 matters. Say your strategy actually wins 60% of the time. That's its true win rate. With only 10 trades, your results could easily show anywhere from 40% to 80% wins. That's a massive range. You could think you have an 80% system when it's really 60%. Or think you have a 40% losing system when it's actually profitable. With 50 trades, that range tightens to roughly 50% to 70%. With 100 trades, you'll usually see between 55% and 65%. The more trades you take, the closer your results get to the truth. At 10 trades, the randomness can completely hide reality. You're basically guessing. At 100 trades, the randomness starts to average out. You're starting to see what's real. Below 100, you're mostly measuring noise. Above 100, you're starting to measure signal. Most traders don't want to wait 100 trades. They want to know now. So they make decisions based on 15 trades and wonder why nothing works long-term. Once you understand sample size, your entire approach shifts. You stop getting excited about 5 wins in a row. You stop getting depressed about 5 losses in a row, because you know it means nothing yet. You stop making adjustments after every bad week. You stop optimizing after every good week. You start thinking in terms of, I'm at trade 34. I need 66 more before I can evaluate this. It's liberating. You remove the pressure of every trade matching. You remove the emotional roller coaster of reacting to noise. You also stop falling for marketing. Every trading course shows you a cherry-picked sample. Look at these 5 trades. 70% win rate over 20 trades. You see through it immediately. Show me 100 trades. Show me the drawdown. Show me the R multiples. Show me real data. If they can't, they're selling noise. Most traders waste years chasing strategies based on small sample marketing. They see a 5-trade example and think that's what I need. They buy the course. They test it for 15 trades. It doesn't work like the example. They move to the next course. The cycle continues because they never learned the fundamental truth. Small samples lie. 100 trades sounds easy until you actually have to do it. If you're a day trader taking multiple setups per day, you might hit 100 trades in a month or two. If you're a swing trader waiting for specific setups, 100 trades might take a year. That's a long time to commit to one approach without knowing if it works. This is why most traders never make it. They're not willing to make that commitment. They want confirmation faster. They want to know at trade 20 that they're on the right path. But the market doesn't work that way. Edge reveals itself slowly. Variance dominates early. You can't shortcut the process. The traders who make it are the ones who accept this. Who say, okay, I'll trade this for 100 trades regardless of what happens. Then I'll evaluate. They stick with it through the losing streaks, through the doubt, through the periods where it looks like it's not working. Then at trade 100, they look at the data, and often it shows edge. Not massive edge, but real, tradable edge. And that's when they really commit. That's when they scale up. That's when they start making real money. Because they're not scaling up based on hope. They're scaling up based on 100 trades of verified data. The traders who quit at trade 25 never get there. They stay small forever because they never verify anything. Something happens mentally when you commit to 100 trades. Trade 7 doesn't feel significant anymore. Win or lose, you're at 7 to 100. Nothing is decided yet. Trade 43 doesn't feel significant. You're less than halfway through the sample. This removes the emotional weight from individual trades. You're not trying to prove anything with each trade. You're collecting data. Losing streaks don't trigger panic. I'm 5 for 15 right now. Not great, but I need 85 more trades to evaluate. Let's keep going. Winning streaks don't trigger overconfidence. I'm 12 for 15. Nice, but variance exists. Need more data. You become detached from the outcome of individual trades. You're playing a longer game. This psychological shift is what separates profitable traders from everyone else. Losing traders can't detach. Every trade matters. Every loss hurts. Every win feels like validation. They're on an emotional roller coaster because they're reacting to noise. Profitable traders know they're collecting a sample. Individual outcomes are just data points. The only thing that matters is the aggregate after 100-plus trades. Most strategies don't work. That's the harsh truth. The truth is that most things you'll test over 100 trades will show neutral or negative expectancy. That's fine. That's the point of testing. Better to find out a trade 100 that something doesn't work than to find out a trade 1,000 after you've scaled up. But you need 100 trades to actually know. At 20 trades, even bad strategies can look good. At 100 trades, the truth emerges. If your expectancy is negative after 100 trades, you have a decision to make. Either the strategy doesn't work or you're not executing it correctly. Both are valuable information, but you can only get that information with a proper sample size. The traders who hop around every 20 trades never get this clarity. They're always operating in the fog of uncertainty. Meanwhile, the trader who grinds out 100 trades on a bad strategy learns definitively, this doesn't work. Next, and the trader who grinds out 100 trades on a good strategy learns, this has edge. Time to get serious about it. Both outcomes are progress, but only if you get to 100 trades. You know what you're doing wrong. You're switching strategies too early. You're making adjustments based on feelings instead of data. You're treating 10 trades like meaningful information. You're lying to yourself about what you actually know. This strategy doesn't work in ranging markets. How many ranging markets have you traded it in? 5? That's not knowledge. That's a guess. My win rate is around 65%. Based on how many trades? 30? Your actual win rate could be anywhere from 50% to 75%. You don't know yet. I've tested this thoroughly. How many trades? 40? You haven't tested anything. You've observed some outcomes and made up a story about what they mean. The solution is simple. Pick one strategy. Trade it 100 times. Then look at the data. Don't adjust it. Don't optimize it. Don't add filters or rules. Just execute it consistently for 100 trades. This is harder than it sounds. Your brain will scream at you to make changes, especially around trades 15 to 30 when you hit your first real losing streak. Ignore it. Get to 100. At 100 trades, you're not done. You're just getting started. 100 trades gives you enough data to make an initial evaluation, to decide if a strategy is worth pursuing. If it shows positive expectancy, you keep going. You trade it for another 100, and another 100 after that. As your sample size grows, your confidence in the metrics grows. At 300 trades, you really know what the strategy does. At 500 trades, you know it intimately. That's when you can start making intelligent optimizations. Not based on hunches, based on patterns in real data collected over hundreds of trades. I notice my win rate is 15% higher when I enter on a retest versus the initial break. I've got 200 trades of each type. That's a real pattern. Time to adjust. This is optimization based on signal, not noise. The traders who make it are collecting thousands of trades on the same basic approach, slowly refining it based on large samples. The traders who stay stuck are collecting 20 trades on hundreds of different approaches, forever trapped in the noise. You can keep doing what you're doing, testing strategies for 20 trades, getting excited about wins, getting discouraged by losses, switching approaches every month. Or you can commit to 100 trades on one strategy. See it through. Collect real data. Make real decisions. One path keeps you guessing forever. The other path gives you clarity. The market rewards clarity. It punishes guessing. Small samples test the trader. They test your discipline, your patience, your ability to stick with something through uncertainty. Large samples test the strategy. They reveal what's real and what's noise. You need both. But you can't get to large samples without surviving small samples first. Most traders fail the trader test. They can't handle the uncertainty. They need to know now. So they never get to test the strategy. They never get real data. They never know what actually works. Stop testing yourself. Start testing your strategies. Get to 100 trades. Then you'll know. Comment below. How many trades have you actually taken on your current strategy?